Welcome to this deep dive. Today, we're tackling a really big topic, building wealth, specifically through investing.
Yeah, it's a fundamental one.
We're using a YouTube podcast script, Investing to Get Rich, the Ultimate Guide, as our sort of launch pad here.
hmm
Our mission really is to pull out the most impactful stuff for you, the listener. We're talking actionable strategies, but also, you know, the mindset behind it all.
Exactly. We've gone through it to find not just the what, but really get into the why and the how of building wealth with investing. It's more than just tips.
Okay, great. Let's just jump right in then. So the source material, it kicks off by really laying out this core argument for investing.
Right.
It doesn't just say it's a good idea. It basically positions it as, well, the most effective way to get wealthy, especially compared to just, relying on a salary.
That's a strong claim.
It is. So
Well,
let's unpack that. Why make such a bold statement right off the bat?
well, I think the key difference they highlight is how wealth is actually
Yeah.
generated, right? Your salary, that's pretty linear. You trade time for money.
Yeah.
Investing, though, introduces this whole other element, this nonlinear thing. Compound interest. It's your money basically working for you independently,
Yep.
potentially, exponentially.
And they've got this really great example to make it concrete. Imagine you put $10,000 into something, say, averaging a 10% annual return.
Okay.
Over 30 years, and this is without adding another cent, that could apparently grow to something like $174,000.
Wow.
That's a huge return for essentially no extra work on your part after the initial investment. It's like your money got a job.
It really is.
Yeah.
That's compounding in action returns, making more returns over time.
Mm,
It looks small at first, maybe, but over the long haul,
it really adds up.
yeah, it becomes substantial wealth. It's such a clear reminder that time is maybe your biggest asset in investing.
The guide also hits on something else, something we maybe ignore day to day: inflation.
Oh, yeah, the silent killer.
Right. It points out that just holding cash, its actual buying power goes down over time. They use this stark example, like $100 today might only buy you what $70 buys in 10 years.
That's sobering. It really is the silent thief of wealth. Your bank balance might look the same, but what you can do with it shrinks.
Mhm.
So investing, smart investing, aims to beat that. Not just keep your money safe, but grow it faster than inflation eats away at it. Protect your future buying power.
Which leads nicely into this idea of passive versus active income. The material stresses how, truly wealthy people often don't just have one income stream.
Right, multiple streams.
Yeah, and a lot of it comes from investments like dividends from stocks or rent from properties, maybe assets just going up in value. It's income they're not actively clocking in hours for.
It's building that financial engine, isn't it? Something that keeps running even when you're sleeping or on vacation.
Exactly. It's a real shift in thinking, away from just earning a living day to day towards building a portfolio of assets that work for you.
Yeah, generating income independently. That's the goal for, financial security and maybe even independence down the line.
Okay, so we've established the why, the argument for why investing is so critical for wealth. Now let's get into the how. What are the actual strategies?
Right. The first big one the guide tackles is, unsurprisingly, stock market investing.
Mm-hmm.
They mentioned that famous stat. Historically, the stock market's averaged something like 10% per year. Now, that number needs a bit of context, doesn't it?
Absolutely. That 10% is a long-term average.
Mhm.
Super important to remember. You'll definitely have years much better than that and, years much worse, even losing years.
For sure.
It's absolutely not a guarantee of 10% every single year. But, over the long arc of time, that trend line points upwards. It shows the potential,
Precisely. And for anyone feeling maybe intimidated by picking individual stocks,
which is most people probably.
yeah, probably. The guide specifically flags index funds, like the S&P 500. It calls them a really accessible way to just get broad market exposure.
So basically, instead of trying to find the next big thing, the next Apple or whatever,
Good luck with that.
haha, yeah, you just buy a fund that holds a tiny piece of the 500 biggest U.S. companies. It's like buying a slice of the whole economy.
That's a great way to put it. Index funds give you instant diversification. Your money's spread out, so the risk from any single company bombing is way lower. It just simplifies things massively.
Okay, and then they mention a specific technique, dollar cost averaging. Why is that such a smart move for regular investors?
Dollar cost averaging is all about taking the guesswork and maybe the emotion out of it.
Okay.
Instead of trying to, perfectly time when the market's low.
Which is impossible.
Pretty much. You just invest a set amount of money, say $100 or whatever, on a regular schedule. like every month. Doesn't matter if the market's up, down, or sideways.
Right. And the benefit is,
Well, two things, really. Psychologically, it forces discipline. But mathematically, when the market's down, your fixed dollars buy more shares. When it's high, they buy fewer. Over time, this can actually lower your average cost per share.
okay. Smoothing out the bumps.
Exactly. It helps avoid that classic mistake of investing a huge chunk right at the market peak out of excitement or FOMO.
Got it. Okay, so beyond stocks, the guide then moves into real estate, another major pillar for wealth building. They say it offers like multiple ways to make money.
Yeah, that's a key point. It's not just about the property hopefully going up in value, that's appreciation.
Right.
You've also got potential cash flow, the rent coming in each month if you rent it out. And then there are often tax benefits tied to owning property, which can be pretty significant.
It definitely feels more, I don't know, tangible for some people compared to stocks. You can see it, touch it.
It does have that appeal. And those multiple income streams are attractive.
Yeah.
But interestingly, the guide pushes back on the idea that you need like a massive pile of cash to start.
How so?
They mention things like REITs, real estate investment trusts, and also house hacking. Let's break those down a bit.
Okay, REITs first. Sounds like something traded on the stock market.
Exactly. REITs are companies that own or finance income-producing real estate across a range of property sectors. So you can buy shares in a REIT, just like a stock, and get exposure to, say, shopping malls or apartment buildings without buying one yourself.
Okay, that makes it more accessible. And house hacking sounds a bit sneaky.
Maybe clever is a better word. House hacking is basically where you buy a property with multiple units, like a duplex or a triplex.
Right.
You live in one unit yourself, and then you rent out the other units.
Mhm.
The rent you collect from your tenants helps cover your mortgage, maybe even all your housing costs.
So you're essentially living for free or very cheaply while building equity in an asset.
That's the idea. It's a way to get into property ownership with lower personal expenses. Pretty smart strategy, actually.
Okay, clever indeed. Then the guide pivots again, this time to starting a business. They draw a pretty direct line between owning a business and, well, serious wealth potential.
Yeah, this one feels almost intuitive, doesn't it?
Yeah.
When you own the business, you're not just earning a wage, you're building an asset.
Your upside isn't capped in the same way.
Exactly. Your potential isn't limited by salary bands or hourly rates. Even, small side businesses, they have the potential to scale up massively. It's about creating something that generates value and grows.
Right, building an asset that can throw off cash and potentially be sold later for a big sum.
Precisely. Entrepreneurship gives you that direct stake in the growth.
Mm-hmm.
Okay, finally, in this strategy section, they touch on the more, let's say, speculative end of the spectrum.
Crypto.
Yep, cryptocurrency comes up. Also things like NFTs, maybe angel investing in startups.
Okay, the exciting, potentially scary stuff.
Yeah. And they're very clear about the risk. They frame these squarely as high-risk, high-reward plays. Meaning, yes, you could see incredibly fast gains, but you could also lose a significant amount, maybe even everything you put in, very quickly.
So the advice is?
Crystal clear.
Yeah.
Only invest money in these areas that you can genuinely, truly afford to lose. Don't bet the farm on the next hot crypto coin.
Got it. Crucial perspective there. Okay, so we've done the why invest and the how, the main strategies. Now the guide shifts to something maybe less tangible, but arguably just as vital.
The psychology.
Yeah, the psychological foundation of building wealth. They actually argue that your mindset, your attitude, can be more important than the specific stock you pick or the property you buy. Why is that?
It's such a key insight. It's because we're human,
Uh,
right? Our emotions, fear, greed, impatience, they can sabotage even the best laid financial plans. We make irrational choices.
Even when we technically know better.
Exactly. So this section digs into a few core psychological traits. First up, delayed gratification.
Right. The ability to resist temptation now for a bigger reward later. They link this directly to like the long-term thinking habits of wealthy people.
It's about being willing to make sacrifices today. Maybe skipping the fancy dinner, delaying the new car for greater financial freedom and security tomorrow. Playing the long game.
It's fundamental to saving and investing, isn't it? Prioritizing that future self.
Absolutely. In investing terms, it means sticking to your plan, being patient through market ups and downs, not chasing quick, flashy wins. Another big one they cover is risk tolerance.
Okay. Accepting that markets go up and down, Volatility is part of the package if you want those potential long-term returns.
Precisely. And they specifically warn against the trap of panic selling. When the market drops sharply and fear takes over and you just sell everything.
Which feels like the safe thing to do in the moment.
It does. But historically, selling into a panic often just locks in your losses.
Mm.
Markets tend to recover eventually. Those who stay the course, assuming the underlying investments are sound, usually benefit from the rebound.
So understanding how much risk you personally are comfortable with is key.
It's crucial. It helps you choose investments you can actually stick with emotionally when things get rocky. You don't want to be losing sleep over your portfolio.
Makes sense. And the last psychological piece they mention.
Continuous learning.
Ah, okay. The idea that the more you know, the better you do.
Pretty much.
Woo!
They suggest a direct link between financial knowledge and your potential investment success. The world of finance changes, new products emerge, economies shift.
Just need to keep up.
Exactly. They even recommend specific resources like classic books, The Intelligent Investor, Rich Dad, Poor Dad, just examples of ways to deepen your understanding. Knowledge really is power here.
Okay, so mindset, patience, risk understanding, keep learning. Got it. Now, having built that foundation, the guide helps us avoid stepping on landmines, common investment pitfalls.
Yes, the what not to do section.
Yeah.
Super important. First up is trying to time the market.
We touched on this earlier with dollar cost averaging. What's the core problem with trying to, buy low and sell high perfectly?
The core problem is it's basically impossible to do consistently. Even the pros struggle, and most fail. Market movements are influenced by so many unpredictable factors.
So the advice is just don't bother.
Pretty much.
Yeah.
Focus on being in the market for the long term, not trying to jump in and out at the perfect moments. Time in the market beats timing the market, as the saying goes.
Right. Okay. Pitfall number 2 they warn about.
Following the hype, or, FOMO investing, fear of missing out.
Chasing trends because everyone else seems to be making money.
Exactly. They use that funny analogy. If your taxi driver or your barber starts giving you hot stock tips,
Aha, maybe a warning sign.
probably a sign that the hype has peaked. It's a reminder not to make investment decisions based on social pressure or what's currently popular. Stick to your own research and strategy.
Don't chase yesterday's winners.
Precisely. By the time something is super hyped, the big gains might already be gone, and the risk of a pullback is higher. Okay, and the last major pitfall?
Lack of diversification.
Yes. Putting all your financial eggs in one basket, whether that's one stock, one crypto coin, even just one asset class like property.
Why is that so risky?
Because if that one thing goes bad, your entire investment portfolio takes a massive hit. Diversification is fundamentally about managing risk.
So spreading your money across different types of investments, stocks, bonds, maybe some real estate, perhaps international assets.
Exactly. It smooths out the ride.
Yeah.
Doesn't guarantee you won't lose money in the short term, but it makes it less likely that one single event will devastate your long-term plans. It's basic risk management.
Okay, super important. So as we kind of wrap up this deep dive, what's the big overarching message you think listeners should take away from all this?
I think, if I had to boil it down, it's that investing for wealth is presented here as a long game, a marathon, definitely not a sprint.
Yeah, patience and consistency seem key.
Totally. It requires discipline, focusing on those fundamentals we talked about, and resisting the urge to chase quick fixes or time the market. And, crucially, starting early if you can.
Right, that compound interest needs time to work its magic.
It absolutely does.
Mm.
The sooner you start, even if it's with small amounts, the more time your money has to potentially grow. That's the real power.
So a good closing thought for everyone listening might be, which of these ideas really hit home for you? Where are you right now on this journey?
Mm-hmm.
And maybe think about, just one small thing, one actionable step you could take. Maybe even today. It could be opening an account, researching an index fund you heard about, maybe just grabbing one of those books.
Yeah, something tangible to start or refine that investment path.
What's one thing you could do? A good question to ponder.